This video is going to deal with all things related to the foreign exchange market. Quickly, the foreign exchange market, you just want to think of as a market in which currencies of foreign countries are traded with one another. And therefore, everything is relative. Like the price of the yen is relative to the price of the dollar price is relative to the euro, so on and so forth. And it's the exchange rate uses supply and demand to determine those rates, and it's important to understand it's not a single market. Like you go to Price Chopper and that's the market there. There's not a foreign exchange market like one place. It's thousands of people, institutions. There's exporters, importers, Art Vandelay, banks, foreign exchange brokers throughout the world that do this. And so that when you hear the forex or the foreign exchange market, you just want to think it's not like one place in the world, but it's thousands of different locations and transactions and millions, really. Excuse me. And what's the purpose of the foreign exchange market? Really is just to facilitate trade. Okay, if I'm Sony and I'm selling something, I want to get paid in yen, but I also want Americans who have dollars to be able to buy my stuff. And in order for that to happen, there needs to be an exchange market. People using one country's currency, if you want to purchase assets like stocks, bonds, or real estate from another country, you also need to get that currency. If you want to buy goods and services, you need to buy that country's currency first. That's really the way you want to view the foreign exchange market. If you're able to get that idea into your head, that whoever stuff wants to be bought, you need to buy their currency to buy their products. If you can just get that thought in and nothing else, you can probably do 90% of foreign exchange questions on the AP macroeconomics exam. And as I said, they're just determined by supply and demand. Okay, so you don't need to, it's very simple stuff. Supply and demand is stuff we did very early in the year. And so let's deal with the labeling for a second here first. Like with every graph, the way I would like you to do this is I would like you to put two graphs side by side. Okay, because it's an exchange market. On the AP exam, they only require one, but they don't hold against you if you put the other one. And I think they almost should make you do the other one, because this is really the way you want to think of foreign exchange. And let's just put over here to the left. Let's say our two countries are Japan, which has the yen, and we'll say the U.S. dollar. Okay, the United States, which has the dollar. So now in the foreign exchange market, you're going to deal with these two currencies. One's going to be quantity of yen. The other one's going to be quantity of US dollars. Okay, and now the vertical axis, you want to remember this is relative. So the yen is going to be priced in terms of the dollar and the dollar price of the yen. So what you want to do is a way to remember this is whatever goes on the bottom here, in that case on the right it's the US dollar, on the left it's the yen. You're going to put the yen over here then closest to the bottom. So that will be on the bottom there, and then it's just the other currency, so US dollar. On the other side, since dollar's on the bottom, you'll put US dollar on the bottom here, and you'll say yen there. And so the one on the left reads the US price of the yen, US dollar price of the yen, and the other one reads the yen price of the dollar in the dollar market. And then you're just going to draw a supply and demand graph. And should they start off equal to each other? I guess, but you don't need to get out like your ruler and make sure it's perfectly level. But just looking at it, it looks relatively level, because ceteris paribus, unless they tell you otherwise, you're assuming they start off in equal positions. And then, really, what you got to do from here is you just got to determine what can cause shifts in the supply and demand for either currency. So, what causes changes to the exchange rate? Well, one thing that can cause it is a change, okay, I'm going to use delta to mean change, in, let's say, a preference for a country's goods. So if people want goods from Japan, then they need to get yen first, because Japanese companies ultimately want to be paid in yen. Now, when you go to Best Buy and you buy a Sony television, you don't have to bring yen with you. But at some point, this is what you want to get in your head, down the chain, your dollars are going to get converted into yen because Sony is a Japanese company. Okay, and does some of it get peeled off and you pay the shippers and pay Best Buy and pay all this stuff? Of course. But in the sake of this course, it's much more simplified. If you're buying Sony products, you're buying yen and then buying Sony products. Okay, so change in preference for a country's goods. If people want those goods, demand for that currency goes up. You could argue if all of a sudden there's a scare, like a couple of years ago, there was an issue with lead in paint and in Chinese goods. maybe the demand for the Chinese yuan would have dropped. Okay, so you could have said the demand would have gone down because all of a sudden people were afraid of Chinese goods. It was really just a small market, so, but you kind of get the point. If something happens that causes you to change your preference negatively for a country's goods, the opposite would happen. Also, an increase or a decrease in real GDP in one country. If a country's real GDP goes up, so let's say the United States, our real GDP goes up, that means as a country we have become richer. Therefore, we want to buy all things, stuff made in the United States. We want to buy stuff made in China, made in Brazil, made in Europe. We also want to buy Japanese products. And so once again, in just the foreign exchange market, because the United States is richer, the demand for the yen would increase. Okay? Because we want to buy products made everywhere, including products made in Japan, and we don't know if their real GDP has changed, remember, because ceteris paribus. The third thing could be a increase or decrease, I'll say a change in real interest rates. Throughout most of the course, you viewed interest rates through the eyes of the borrower. Lower rates, people want to borrow more. Higher rates, people want to borrow less. That's really how monetary policy works in many ways, and how the Fed, why they buy and sell bonds to change interest rates. Well, in this case, you want to view it from the person making the loan's perspective. If you have a choice to loan in Japan and loan in the United States, so you have money to loan, and you can make a loan to someone in the US or someone in Japan, and you view those two people absolutely identical, okay? They are, in all ways, except their nationality, they are exactly the same. Okay, they're as likely to pay back the loan. They have a very similar job, the same amount of job security. Credit scores are exactly the same, all the same stuff. Who are you going to want to loan money to? Well, if Japan offers you 5% interest rates and the U.S. offers you 2% interest rates, you're going to loan to Japan because you can earn more. You can make 5%. It's almost like if I said to you, let's say the Kentucky Derby was this past weekend, and we live here in Saratoga, so let's just say that I said there was two horses you felt absolutely the same on betting, and you could bet on one horse at the track this summer was going to pay you 10 to 1, the other one was going to pay you 2 to 1. But they're exactly the same horse. They were cloned, okay, and they were trained the same way. Well, you would probably, if you're going to bet, you might as well bet on the one that's 10 to 1 because the rate of return is higher, all other things being equal. Same thing here with number 3. Change in real interest rates. Foreign exchange, you seek out higher interest rates. You demand that country's currency. Speculation can cause it. If people think a currency will change, like if they think a currency is going to appreciate, they'll try to buy it before it appreciates. You just want to view this like you would a stock. If someone tells you, hey, the price of Apple is going to double in the next week, you want to buy it today so you can benefit from the rising value. Same thing here. If, at the other hand, people say, hey, Apple's going to drop, they got a big scandal coming out, you might want to sell. Same thing with a foreign currency. You might want to get out of that currency because you think the speculation is going to, the bubble, if you will, is going to burst. You want to sell high and buy low. That's the goal. But once again, it's speculating, so you're trying to anticipate that and beat the market, if you will. Last thing is, the fifth thing would be a change in price level in a country. Okay, if a country's experiencing domestic inflation, they might look for cheaper foreign products. Okay, so if there is massive inflation in the United States and you're going to go to college in Potsdam, let's say, not only should you be wearing lots of winter clothing probably the entire time you're in college, but you also might decide to go over the border to Canada to buy products there, you know, buy your toothpaste or buy whatever else you need for college in Canada because it's cheaper there. Okay. At the same time, Canadians won't be coming to the United States as often to buy American products because we have inflation. It's driving up the price of our goods. Okay. So people are seeking cheaper goods. All right. So we have that list there. So those are really the 5 things that can cause it. And then what you want to know is what is going to be the impact of this on exports and imports, all other things being equal. Well, if a currency appreciates, it means it goes up in value. And I'll graph this in a second. What you want to understand is the price of foreign goods decrease Okay, so stuff from Europe, let's say, if our currency appreciates, European goods now are going to be cheaper because it's easier to buy, it's cheaper to buy European currency than to buy European goods. So it appreciates, therefore net exports are going to go down. Okay, currency depreciates, and it impacts both exports and imports. So maybe I should show you that. Net exports is exports minus imports. Well, think about this. If our currency depreciates or goes down in value, it's cheaper to buy our currency. Therefore, it's cheaper to buy our stuff, so exports go up. At the same time, it's more expensive for Americans to buy foreign currency. Therefore, the price of foreign goods go up. Therefore, we import less because their stuff's more expensive. When it appreciates, the exact opposite happens. Exports go down, imports go up. Okay? And then all you have to do really is then figure out, well, how is the appreciation or depreciation usually going to change aggregate demand? Well, remember, aggregate demand is C, I, G, and net exports, or exports minus imports. Okay? So if an appreciating currency, okay, if a currency appreciates, if it causes net exports to go down, well then appreciating currency, net exports go down, that causes aggregate demand to go down. And if a currency depreciates and net exports are going up, okay, this is going to cause aggregate demand to go up. And that's part of the reason why I want you to always label this when you draw your aggregate demand curve, because usually when they ask you about the forex, the last thing they'll do is tie it back into aggregate demand. We'll now show the impact on aggregate demand, and you can see it impacts net exports. Okay? So let's come up with a couple, let's just graph a couple here. So we'll say this is quantity of euros. So we're talking about European products, so euro goes there. And we'll say, once again, we're using the yen. And then therefore on this side, it's going to be quantity of yen. So yen goes on the bottom, euro goes on top. You have supply, demand, supply, demand. Okay? The way you want to view the forex, if this is helpful to do, is to think of the forex, the foreign exchange market, or the forex, as a place where you can go to get whatever you want in terms of foreign currency. It's very accommodating. It's not restrictive. It's super welcoming. Come on in. Whatever you want, I can get you. The thing is, the forex has one rule. You can't get anything for free. And that's kind of like a life rule, right? You can't get anything for free. There's no such thing as a free lunch. Same thing in the forex. So if I'm an American, or if let's say I'm a German, and I have the euro, and I want to buy a PlayStation 3, which is made by Sony, so I need to buy Japanese yen, that's fine. I can buy that product in our world. The only thing is I need to get yen. So I have to go to the forex and say, hey, forex, I would like some yen. So on the market for yen, I'm demanding yen. So you see what happens there. The demand curve shifts to the right. The forex, okay, says no problem. Okay, I can give you whatever you want. You want yen, I can give you yen. The only thing is you have to give me something. Well, as a European or someone in Germany, what I have is euros. I get paid in euros. We deal with euros. It's sort of like us in the United States with dollars. It's just everywhere. So what do I have to supply? I can supply the foreign exchange market with euros. So it's almost like I throw them into the forex. Okay, if you view the forex as like a pit almost. I throw the money into the forex, and out pops yen. Okay, and now what you see here, every time you draw these graphs, you want to write this currency, you want to write right above it, this currency depreciates, this one appreciates, and that's what they mean. And what does that mean? Well, if you just look at the price level here, the price level went up, that's appreciating. The price declined or went down, that is depreciating currency. But when you talk about currency, you want to use the terms depreciates or appreciates. Okay, so that was wanting to buy a country's particular goods. Let's say you had quantity of real. Okay, we're dealing with Brazil's currency, real and the US dollar. Okay, and you're now looking quantity of US dollar. We read an article on this in class, actually, about the currency situation and the the interest rate problems in Brazil. The rest of the world has been cutting interest rates. Brazil was worried about inflation, so they raised their interest rates. Because they had higher real interest rates, people were demanding Brazilian currency. And in the United States, we were therefore supplying U.S. currency to get the real to loan to people in Brazil. Okay, because we were doing that, their currency was appreciating, ours was depreciating. Well, that really hurt Brazil's economy the past year because it caused their net exports, okay, remember here's real, here's Brazil, caused their net exports to go down. And Brazil relies a lot on net exports to boost their aggregate demand. And so they've responded by cutting interest rates even though they're experiencing some inflation, which seems to be a risky move, but they're afraid it's going to hurt their economy too much. Okay, so this is how you want to think of the foreign exchange market. It's a kind of a play between the two. Hopefully this is good enough. If you have other questions about this, feel free to ask me in class. But you really just want to figure out, once again, who wants whose stuff, demand that stuff, and then the other country needs to supply their currency to get the currency they're demanding. Okay? Hopefully you found this useful.